Make no mistake about it. Crypto is in crisis. Now, it's not because of China or some new US tax bill or quantum computing. No, this issue comes from within the very design of blockchain. It's called Miner Extractable Value, or the MEV Crisis. Now, that name is very jargony and complex, so think of it this way. It is a third and unexpected revenue stream for miners. And the problem with this third revenue stream is that it's predatorial, and you and me are the prey. Hey everybody, welcome back to The Art of Speculation. I am your host Orion, and in this episode, we are exploring the MEV crisis, or as I like to call it, the third and unexpected revenue stream for miners that's thrown crypto into crisis. Not so catchy a title, so you get why they call it the MEV crisis. But it is true. You see, historically, miners have had two main ways to make money. The first is something called block rewards, and the second is transaction fees. Now, let's dispense with the jargon and complexity for a moment and actually explain what block rewards and transaction fees are. And to do that, I'd like to start at the beginning. Now, in 2008, an anonymous person or group of people, for all we know, quietly published a white paper online called Bitcoin, a peer-to-peer electronic cash system. Now, in this white paper, which is just 8 pages long, they proposed a novel way to use cryptography or math to create digital cash. Now, digital cash already existed at the time. There was no shortage of ways to pay your bills online or send money to somebody by email, but all of the existing methods required a middleman, something like a financial institution, a bank, or a credit card company. And the problem with middlemen is they require trust. They require you to trust them absolutely with your money. Now, that is the problem that Bitcoin was trying to solve. They wanted to make e-cash or digital cash that was peer-to-peer completely, no middleman requiring your trust. I want you to think about your bank for a second. When you deposit money, you trust that your bank is going to update your balance somewhere in a database and accurately maintain that balance and only let you access it. The bank is at the center of all of these transactions. When you deposit, you go to them. When you withdraw, you go to them. When you want to move money, you tell the bank to give the money to somebody else. And they do this for millions of other people. This is called a centralized system. And it was what Bitcoin was trying to avoid, to have no one central authority. So Bitcoin proposed, let's use a network of databases instead of just one. And each one of these databases, called nodes, will have all of the transactions that go into a bank's database, so you won't have to trust any particular node. The network will be full of nodes that all know what the balances should be. Now, Bitcoin also wasn't the first to propose a decentralized network of nodes to manage financial transactions, but they were the first to solve some of the problems that come with that. And one of the biggest ones is, who's going to pay for all this stuff? Think about it. A bank can afford to run those servers and pay for the electricity and the space and the technicians required to run it. There's a lot of costs associated with maintaining that book of record, that database for millions of people and millions of transactions. And now we're going to have multiple copies of it, lots of copies of it spread across a network. Who's paying all these people? Well, Bitcoin came up with an incredibly novel way to create an economic incentive for people to dedicate their computing power to the Bitcoin network to become one of these nodes. The solution is called mining, and it goes like this. Anyone who runs one of these nodes is allowed to participate in a little game, in a little mathletic competition. Whoever wins the race gets a prize. They get 6.25 newly minted Bitcoins. Now, at today's valuation of about 49,000 US dollars per Bitcoin, that's over $45 million per day distributed to the mining community. In the Ethereum network, The block rewards are about 2.5 Ethereum or $8,000 per block, but their blocks run every 13 seconds. So the competition repeats every 13 seconds, meaning Ethereum gives over $55 million to its mining community every day of the year. So there is a lot of money at stake in these competitions, and it creates the financial incentive to run one of these nodes. Because if you don't run a node, you can't play this game. And everyone who runs the node and plays this game is called a miner. The game is simple. It's a race to solve a cryptographic puzzle or a math puzzle. The one hitch is the only known way to solve this kind of math puzzle is with brute force, guessing randomly again and again and again. Fortunately, computers are really good at this, and the more computers or computing power you throw at this, the more attempts you can run per second, the more guesses you get per second, increasing the chances that you are the first to solve this problem. And the miner who does solve this problem first wins a prize and is said to have found the next block. Because it's through this process of running this race and playing this game and finding that cryptographical puzzle solution that new blocks are added to the chain. Only when one of these puzzles is solved is somebody rewarded and recognized by letting them add the next block to the chain. Now, when a miner finds a block, a few things happen. First, they are awarded that 6.25 freshly minted Bitcoins or the 2.5 Ethereum that I mentioned. And this is called the block reward. And it represents the first revenue stream for miners. Next, the miner who found the block, i.e. who won the race, is responsible for choosing which pending transactions they scoop up and include in their block. They get to choose. Remember, any transaction not yet included in a block hasn't happened. It has not been executed. As a refresher, this is how I explain it in about 60 seconds in my previous video. Blockchain is a great way to describe the technology because it's effectively blocks of data all chained together. And the Ethereum blockchain, new blocks are formed about every 15 seconds or so. And each block can only contain about 70 transactions worth of data. So you've got 70 transactions being processed about every 15 seconds. And if you are not in one of those blocks, your order is pending. It's not going to be executed. And once a block is formed by the miners, the 70 transactions contained in that block execute in chronological or priority order. They go in a perfect sequence until the next block is found and the next 70 transactions, plus or minus, are put into the next block and that executes. And if you are not in a block, whether it's a transfer of money, whatever the transaction may be, an order to buy, order to sell, trying to move money, a sophisticated contract, you name it, any transaction can't go through until it's put into a block. But here's the challenge. I'm going to go to Etherscan right now. I'm going to go to this blockchain dropdown and select View Pending Transactions on Etherscan. And you can see there's 150,000 pending transactions. Blockchain is wildly popular right now. Crypto is wildly popular, and there is an impossible backlog of transactions. Now, 5 to 10 years ago, there weren't even enough pending transactions to fill a block. A miner could just scoop all of the pending transactions, throw them in their block, and be done with it. But as crypto grew in popularity, the transaction backlog grew and grew and grew until it got bigger than the number of transactions that could fit in a block. And when that started to happen, people started adding tips to their orders to incentivize miners to choose their order over everybody else's. These tips are called transaction fees, and they represent the second revenue source for miners. Now, both of the revenue streams I've covered so far have always been known and always been expected, and they're actually good for blockchains. Yes, even transaction fees contribute to network stability, but more on that another time. Now, since miners are allowed to choose which transactions to put in their block, and they are motivated by money, they're spending a lot of money on their hardware, electricity, and storage space, they're going to scoop all of the transactions with the biggest tips to include in their block, thereby maximizing their tip revenue. Now, miners cleverly also tend to stack the transactions in their block by tip size. So the biggest tip goes at the top of the block. It's the first transaction to execute. And the lowest tip goes at the bottom of the block, and it's perfectly prioritized in the middle. This practice helps miners make even more money from tipping, because now people can try to outbid each other to have their transaction executed first. It effectively turns tipping into an auction for transaction priority. As Ethereum and smart contract-based blockchains became more and more popular and got used for more and more things such as DeFi, the money to be made in ordering transactions cleverly exploded. It grew exponentially. In my previous video, I show a real life example of a front running bot that was just printing money, front running orders, $1,500 here, $200 there. When we looked at the wallet address on Etherscan, the bot had racked up over $500,000 and was continuing to pump out money every single day. But you gotta ask yourself, where is the money coming from? What causes that bot to profit? And the answer is ordering of transactions. Bots make money by cleverly ordering their transactions relative to other ones. The order of transactions in a block has value. If you were to take the exact same set of orders and reorder them, you would effectively be redistributing wealth in a totally different way, because order of transactions itself has value. Generating revenue from the order of transactions represents the third way that miners could make money. For example, let's say that a miner notices one day that there are a lot of large buy orders for Dogecoin on a specific decentralized exchange, a DEX. In theory, the miner could create their own order to buy Doge and put it right at the top of their block, and then find all of the biggest orders for Doge that it can find and stack all of those buy orders right underneath their buy order. But they save the last spot in the block for their sell order. When this block gets added to the chain and all of the transactions execute, boom, their buy order is going to lead things off, followed by subsequent buy orders pushing the price of Doge up. They've crafted the block with only the largest orders right behind them, pushing the price up, and then boom, they sell at a profit. Now, that is a highly contrived example, but it goes to show the point. Now, if you look at the revenue the miner generated in this example, they actually have three sources of revenue. The first is the block reward, the 2.5 Ether they got for finding the block. The second are the transaction fees, the tips that they got from the Dogecoin orders that they put into their block. Yeah, they take the tips, even though they get the revenue from the third revenue stream, and that was by ordering the transactions in a way that favored them at everybody else's expense. Now, this third revenue stream was never expected, and it could become a really, really big issue for crypto if miners genuinely start to pursue it. Fortunately, that hasn't really happened yet from what we can tell. Miners and bots so far have kind of happily coexisted, profiting in their own unique way from their own unique set of skills. You see, when bots kind of first showed up on the scene back in about 2015, they used tipping as a clever way to outbid their prey, sandwich their orders, and make a little bit of money. But then more and more bots started appearing And then multiple bots would find the same opportunity to sandwich a trade, and they would start bidding each other, beginning an auction to screw over some unsuspecting DeFi trader. This, in turn, caused network congestion, pushing transaction prices up. Now, miners didn't object to some bots making a little money. Besides, these bots were using tips as an auction, pushing the prices of transaction fees up, fattening miner profits. And when DeFi summer hit in the summer of 2020 and loads of new front-runnable juicy orders started showing up on the scene, bot bidding on top of all the volume from DeFi traders pushed transaction prices to absurd levels, often exceeding $40 per transaction. Imagine your ATM cost you over $40 to withdraw your money. That's what was happening. So it's fair to say that miners were happy and bots were happy, and they were just making money together. But after months and months of persistently high transaction fees being paid for by the community of Ethereum users themselves, the Ethereum community decided to do something about it. A new Ethereum Improvement Proposal, EIP-1559, was drafted and approved. Now, EIP-1559 is typical jargon. It later got renamed the London Fork, and that just rolled out in August 2021. And what did this fork do? Well, it changed the way that transaction fees are distributed. The objective of this change? To make transaction fees more transparent and predictable. The impact? Miners make less money. Bots can still continue to bid against each other, pushing prices up, but the additional profits are no longer distributed to the miners. And this really begs the question, why don't miners now just build their own front-running bots? You see, the London Fork, which actually aimed at solving the problem of persistently high transaction fees, might actually be the thing that causes miners to build their own bots to maximize the value they get from ordering the transactions in their blocks, because they're not making as much money as they used to on the transaction fees. Now, if miners actually start to do this, it gets really bad for crypto in two main ways. First, from a relationship perspective, it pits miners against the very community of users that they serve. I mean, think about it. The people responsible for executing the transactions on the blockchain are now economically, financially incentivized to process that transaction in a way that is beneficial to them at your detriment. That is not good, and not the sort of foundation that's going to build the long-time trust that's needed for crypto to thrive. Now, second, and this one is profound and at the very heart of the MEV crisis. If miners do this, it compromises blockchain security. See, while block rewards and transaction fees are generally worth more than the value of reordering the transactions in the block, there are times where that isn't true in a big way. In fact, there's this great story from the summer of 2020 where a crypto coder happened to find a vulnerability in a DeFi contract that had around 10 million US dollars in it. And this vulnerability wasn't overly complex to understand. It was only a matter of time before a hacker was going to exploit it. So after considering a couple of options and working with the actual group that ran that DeFi contract, they concluded that the only way to save this money was to actually exploit the vulnerability themselves and get the money out to protect it from hacker attacks. But the problem was this: as soon as they would have sent their transaction to rescue the funds to exploit the vulnerability, bots would have tried to front run that order. They were so pervasive and so sophisticated already that even orders as complex as a transaction to rescue funds from a DeFi contract by exploiting a vulnerability could be copied by these bots. So once they'd send the transaction, a bot would find it and start bidding it up to front run it. In fact, multiple bots would, and almost surely their order would get front run and someone else would get that $10 million. Want to know how they saved the funds? They hired a miner to put their rescue transaction at the top of the block so that no one could front run it. They went straight to the miner who has the ability to author the block. Now, while that seems at first like a good news story, it actually has a really scary angle to it. You see, the value from the third revenue stream, the value of ordering the transactions in a block, is worth $10 million in this block. The value of the first two revenue streams, block rewards and transaction fees, is only going to be about $25,000. This means that the value of making that last block is $10 million. Now, if there were a way for you as a miner to remine that block so that you could author the transaction ordering instead of the person who did, well, then you could replace their order with a copy of your own, stealing the $10 million. And this is what makes MEV so scary, because it is possible to remine blocks. Miners almost always focus their efforts on finding the next block instead of trying to remine the last one, because typically the block reward, which is consistent, and the transaction fees, which are kind of predictable, are generally as good or better in the next block than in the last. So why risk remining the last block? Just mine the next one. Keep mining the next one. Keep things moving forward. Maintain the status quo and don't jeopardize the security and trust in the network. But when scenarios like this happen, and there is a $10 million difference between choosing to mine the next block versus trying to remine that last one so that you can scoop that $10 million, well, now the financial incentive is clearly in favor of remining that last block. And miners who are wise to the way of front running and have methods available to them to quantify the value of the order of transactions in a block can now see the difference between the value of mining the next block versus remining the last block. And when that delta gets big enough, $10 million worth, there's genuinely an argument to be made to, hey, attack that last block. Remine it. And when that happens, the entire network becomes vulnerable to something called a time bandit attack, amongst other types of attacks, because the chain isn't moving forward anymore. There's nobody adding new blocks. They're all just fighting over that last block and new ones aren't being produced. And that is what makes the MEV crisis so scary. Any of the material I've referred to today, I will include down below in the links so that you can check it out. I highly recommend to check out that Flash Boys 2.0 paper that I referenced at the beginning. And if you've watched this far, please like and subscribe and share this with somebody that you know who is into crypto. There's a lot of chitter chatter in the crypto community about the MEV crisis, about miner extractable value. And now you know what that means. It's the unexpected third revenue stream for miner that could throw the entire crypto world into crisis. Now, despite this, I am still an advocate of crypto. I am a holder of crypto myself and believe that the technology will succeed over the long term. Because as soon as you have a crisis of this proportions that could potentially affect a multi-trillion-dollar market, you can bet that a lot of smart people are spending their calories trying to solve this very problem. So in one of my next videos, I'm actually going to talk about what I think might be the best chance to save us from the MEV crisis, at least in the near term. And that thing is called flashbots, which sounds a lot like Flash Boys, which is a book by Michael Lewis about arbitrage bots who skim off about $5 billion a year from Wall Street. Is that a coincidence? Flash bots, Flash Boys? I think not. We'll see you next time.